Hello and good evening, everyone. Welcome to the Business of Property. I'm your host, Cheryl Leong from Property Development Australia. I begin today by acknowledging the traditional custodians of the land on which we virtually meet today and pay respects to elders past and present, and I extend that respect to our Aboriginal and Torres Strait Islander peoples here today. So, at the Business of Property, we interview superstar guests in the property development space and share their expertise, their deals, and their stories to help empower, build, and grow our community of property developers. And today, the superstar, no less, who is someone who is quite well known in the construction finance and joint venture space, Mr. Dan Holden from the Holden Capital. Dan, who I'm going to introduce over to the property development platform in a moment, has just released his first book. It's self-published, Constructive Finance, and there are a whole lot of insights in there which I'm going to really love diving into this evening with all of you. So I'd love to introduce Dan. Come on down.
Hey Cheryl, thanks for having me. Much
No,
appreciated.
very, very excited to have you here. So, Dan, congratulations on the launch of your first book. Exciting
Yes,
stuff.
it is.
And I know that yo Cheryl Leong. I can't see who your name, but thank you for joining us. Any comments and any congratulations to Dan? Please pop it in the comments. Dan, obviously, I'd like to understand. Let's start back from the beginning. I understand your journey, how you started in the finance space, and where it's taken you over the last sort of not over 10 years.
Yep. Yeah, so 20 years ago, I started doing acquisition and development management, so small to medium residential projects. And I did that for about 5 years, working for a developer as their development manager, doing acquisitions, build and negotiation, delivery, and sales and marketing. And then probably about 2007, I realised that finance is actually a really important part of the project life cycle. And I was approached by a big national firm to come and work with them in the Brisbane office. They're a firm called Ashmorgan Winthrop. So they were very large, probably the largest in the country. They did about $3 to $4 billion a year in debt, mainly construction. They did joint ventures. They ran a small investment fund of about 300 million, which they invested into projects. And so that was more, I'd say, medium to high-end size projects. So I worked there for almost 5 years over the GFC as a broker and investing their balance sheet into projects. And so that was a great transition. And then I guess as the kind of GFC very much slowed down new property projects coming out of the ground, it was they kind of shifted their business focus. They started acquiring big shopping centres. I think they've acquired over $1 billion of shopping centres in the last kind of 8 to 10 years. So they took a different tangent. And so to keep doing what I love doing, which is funding projects, I essentially was, I guess, forced to step up and start my own business, which I did 10 years ago to almost to the day. 16th of December 2011, I registered Holden Capital
There we go.
and set up my own shop.
2 days from the 10-year anniversary. So congratulations. I mean that in itself, you're not only just funding projects, you're building a business that's around supporting developers. So Dan, when did you sort of really see that developers, because for a large part of the last decade or so, a lot of developers were still using the big four banks to fund projects. At what point did you really see them transitioning across to going, all right, well, it's not even going to be a second choice or third choice, it's going to be our first choice?
Yeah. It's probably from, I guess, where I started to fund the projects that we were funding back when I was a development manager. Some were with banks, but quite a few were with the non-bank sector. And before the GFC, it was very strong. There would have been 150 odd lenders providing private capital. And when I say private capital, I mean not the big four bank money into projects. So they were, the traditional mortgage trusts that were around back then, and they were, lending at similar rates to what they are now, as in kind of the late single digits, and doing projects at slightly higher risk but slightly higher cost of funds. So they were always around, and then in the GFC decimated a lot of them. So I think post GFC, kind of when I was doing this for Ashmorgan and set up my own shop, it was probably 10 to 12 to 15 lenders that were still lending and reputable, because quite a few of them, I guess, didn't carry themselves very well during the GFC, as in trying to get their money back and carrying on like cowboys. So ones that we could regularly deal with and transact with, there was probably a dozen left. And then now it's definitely growing. So post GFC, it was probably a big focus on bank to fund quite a lot of projects, because there weren't many providers of non-bank capital. And then I'd say probably about 4 years ago, it started to really rocket up in terms of the amount of non-bank lenders. Now there's one every week popping up with kind of a couple of minutes experience and a bit of money to lend out. So that also brings its own risks as well. So it's definitely an interesting space. Now there's capital aplenty, choice aplenty, and that brings about a different set of decisions to make before you decide who to partner with to fund your project.
Yeah, which is, I mean, this is probably one of the reasons that you've decided to write this book. I mean, tell us a little bit about the book and what who is it for, and what can we expect to be finding in the pages.
Yeah, so I very much wrote the book because essentially there wasn't one there. It was kind of the book that I wanted to read, and no one had written it yet. So I thought, well, after my experience, I started the book 4 years ago, November 2017. It took about 6 months to write probably 80% of it, as in the content, to just put words on a page and kind of, frameworks and ideas onto a page. And then I kind of let it sit for the better part of a year. And then we started the editing process this January. So we went through 3 editors, and that took about 10 months. And then we finally got the finished product, and now holding it in my hand, which is exciting. So, but I guess another reason why I wrote the book was a lot of the conversations I was having with developers in a one-to-one fashion, as they call up and say, "Hey, I need 5 mil or 10 mil for this project." The same kind of discussions having over and over again. It was kind of like, well, instead of having that conversation one-to-one, to put it in book format and share it, is then having that same conversation one-to-many. And so, don't have to repeat myself as much and cover that much ground with so many different people. But also, the size of our business and the amount of projects we can fund in a year, we're not able to work with everyone and kind of touch every project. So it's sharing that information on a wider scale. So it's a little bit of secret sauce sharing, a little bit of, but also it makes a better borrower for me and our team. If someone has read this book and is up to speed with it, I'm sure half the people think they already know it all and probably don't. You might be surprised. There might be something in there you don't know, but at the end of it, if you have covered all of that, you're then a better borrower for us as well, and other lenders to work with, because you've then got the basics covered, and you've also got, I guess, more insights into the kind of frameworks that lenders look at. So both our team as broker, when we're pitching deals to other lenders, and us as a lender in our own right, the kind of checklist that we're looking at, the kinds of things that we want to see in a proposal, about the sponsor, about the project, about the risk, so that we can quickly measure the risk and then judge the appetite to fund the deal, or the cost of funds or the gearing that we can achieve for the developer to get the outcome that they need. So getting all of that delivered to the lender succinctly, and getting to the decision maker, that information to the decision maker quickly, is all part of, I guess, getting a better process. So it makes it better for the borrower if they've got that knowledge and they know the process. They're better educated. They then can have a better experience themselves. But also it's better for us on the lending side or broking side that we've got a better, I guess, experience for us to deal with that borrower as well.
Absolutely. And you touched on it very briefly. What does Holden Capital do? I know you mentioned you're a broker and a funder. So just sort of bring it back to sort of 101. What's the difference there?
Yeah, sure. So 10 years ago, we started as a finance broker, and we still do that today. And so that's, I guess, us being approached by a developer to say, hey, I need 5 mil, 20 mil, 50 mil to fund this project. And us looking at our lender sheet, which is currently about 160 lenders, and saying who's best suited for this. And that's very much about knowing who has appetite at the moment, particularly in some of those smaller funds, or when I say smaller, I mean, they've got a couple 100 mil there, but they might be getting quite full at the moment, or they might be underexposed and therefore want more, have appetite to get more money out quickly. So having all of that kind of knowledge, which is knowledge you get by talking to them daily and weekly and monthly about what they want to see and what they're keen to do, then kind of, saves time and effort to get that process done quickly and get an approval quickly and get your project funded quickly. And I guess the best terms as well. So that's all about just knowing the lenders, knowing what their appetite is, knowing what their current policies are, and knowing what they want to see so that we can match the project with the right lender. And that also includes joint venture funding, partnering capital with projects and developers. And that might be an ongoing capital partnership. It might be a standalone investment. So we do that as well. Or it might be actually a skills-based partnership. So we've done quite a few of them over the years where it's actually bringing in a developer with the skill set to actually deliver the project on a profit share basis. So there's many ways a joint venture can take shape, and we cover that in the book in quite a bit of detail. So land-based joint ventures, all that kind of stuff. So all of that side is on the brokerage side, which we do and have done for the last 10 years. And a lot of the guys in our team have done it for a very long time. I think most of the guys in our team are 5, 6, 7, 8 years here in our business with us. So it's long team and good guys that I've known for before they started the business. And then there's us as a lender. So about 4 and a bit years ago, we started our own lending side. Prior to that, we did the lending in association with another wholesale funder. So we were doing the lending for a couple of years before that. But about 4 or 4.5 years ago, we set up in earnest on our own with our own investors. And so that's Holden Capital Partners as a lender. And so since then, I think we've just ticked over 200 million investor capital raised and lent out on projects. So that's over probably, I think we're up to loan number 47 now across that 200 million. I think last quarter we did 29.9 million raised from our investors and funded projects. And this quarter we're on track for 46 million. I think we've got 5 settlements this week, and that's us as a lender. So that's us raising money from our investor base, putting together the, I think the one we settled today was 5.6 million construction loan on a land subdivision. No pre-sales. I think it was 7.25% interest rate, 65% LVR. Good sponsor that we've dealt with before. So that gives you, I guess, a little snapshot of a deal that we funded today ourselves as a lender.
And so what sort of percentage of loans are you doing sort of through your own fund and through the brokerage?
It very much depends on what suits, I guess, what we can do and what suits better for somebody else to do. I mean, we did last quarter, I think we did 2 loans that were 13 million each, whereas probably 12 months ago, that would have been better cost of funds to the borrower to somebody else to fund that project or that loan. And so it depends on what's actually better. And so for quite a while now, we've actually provided a desktop funding summary to the developer with 3 options. And if we're the chosen option, great. We're not trying to hide who's which. We're always transparent, but we'll say, look, here's, generally it's a bank or a semi-bank style option, which is, probably lower gearing, higher number of pre-sales, a lot more qualifiers, which might be a bank or a regional bank or a low-cost mortgage trust. Then it might be a middle-tier mortgage trust, and then it might be a much more kind of rushed, higher costs, lower barrier entry lender. So we'll give a couple of options, talk through with the developer, find out what their motivation is. A saying is, do you want it cheap or do you want it quick? I guess is, if you want it cheap, then it should go with a bank and you jump through those hoops and get that lower cost of funding, and that's great. We're still doing plenty of bank loans at the moment for clients. But some people just want the certainty to get it funded and get it done and get it built, or particularly a lot of projects you're seeing at the moment in the last 2 or 3 years, there's a lot more product that is actually higher end and harder to get pre-sales on. So, trying to get pre-sales on $2 and $3 million houses or $2 and $3 million apartments off the plan when it's just a piece of dirt as a development site is a lot harder. So that might not suit bank funding, and you just borrow from a non-bank because you want to get it out of the ground without doing any marketing and deliver the project when it's finished and show how beautiful the project is and get people through it and stage it and get them excited and do open homes and, have 50 or 100 people through the first open home and 5 contracts and there's a bidding war. And that might be your development play, which we're seeing a lot of people do at the moment with that
In the
higher end
current
product
market,
is to get people emotional about it, get them excited, and extract the value that way. So that might be another kind of approach. So it depends on what the developer wants. Depends on what their game plan is and their strategy to delivering the project.
Absolutely. Well, let's dive into some of the topics in the book, because I've had a good read, and I really like the structure of it, because absolutely agree with you. There's nothing there that's educating people about the finance side of things. There's, we're educating people about how to be, how to find development sites, how to become a developer. Then there's this bit where you're like presenting to commercial lending, and so I mean, maybe we step back a little bit, because at what point does someone go from residential lending finance to commercial finance?
Yeah, so I guess there's probably a couple of different ways you could answer that one. One way that I would approach it is to say at some point developers start out and it's a bit of a cottage business, a lifestyle business for them, that they're just doing one or two things a year that kind of, they've probably got a day job and they're doing this kind of on the weekends or at nights, and they're trying to put together a little deal, and that's fantastic. That's I guess either how you start or how you create some good passive income along the way alongside your day job, and that's fantastic. And those kind of developers would probably be well catered to deal with their bank, their home loan broker, to set them up on a they'll lend 80% of site acquisition price at 4% interest rate, and they'll rely on your income statements to verify the income, and all of that stuff is a different process. And something that if you can stay there, then sure, stay there. There's nothing to say that you should or have to step up to a proper commercial lender. So probably the next step is when you're actually borrowing multiple projects at a time, when your income doesn't service the amount of debt that you're needing to borrow to do the projects that you want to do at a single point in time. Your projects are overlapping too much, and so therefore you're not meeting the criteria. I mean, the debt to income kind of matrix has been tricked a bit in the last 4 or 5 months again. So, jumping through all those hoops becomes a little bit harder. Getting approvals takes a lot longer because they want to forensically go through your whole portfolio, and they might want fresh valuations on everything. And, it just starts getting, it feels like you're swimming upstream. And so that's probably the time when you'll feel it yourself to say, right, I should probably deal with a commercial lender like us. And as I said, there's 160 of them out there, so there's plenty of choice out there at the moment. And probably the benefit you'll get, I guess, from a commercial lender is much quicker approvals. So most things we try and approve within a day or two of having the information. But the information we require isn't, a long history of PAYG statements and home loan statements and any of that kind of stuff. It's what are we building, how much you need to borrow, what's the build price, what's the GR, and the basic feasibility. Preferably not a big estate master model that's confusing, just something simple that says, this is what I want to build, this is how much you need to borrow. We can turn those around within a day, and it's much easier. Most of them we settle within 5 to 10 business days from start to finish. Obviously, maybe allow a little bit more if you don't have a valuation yet. So yeah, it's speed to market, and it's also borrowing more. So banks will generally lend 70 to 75% of project cost. So that's if you're building something for 10 million, to pick a number, they're going to lend you 7, whereas we'll lend 8 or 8.5 mil. So we'll lend more with lower qualifiers, i.e. we're not seeking your income to service that debt, and lower pre-sales. So we're not generally seeking pre-sales to extinguish our debt before we lend you the money. We're taking a bit of market risk. And so that would be a case of us having our own knowledge of the area and relying on a qualified valuer to do a project valuation to say they're building 10 houses worth $1 million each, 10 mil end value. We're comfortable that the sales rate of that product is 1 per month or 1 per 2 months, and so therefore we know that when it's launched to market properly, that there's going to be enough sales there to get our debt down to a point where they can either extinguish us completely via sales or refinance us into a residual stock facility, which either we can provide, or they can go back to their bank at that point, refinance it back to their bank and hold it for a period of time as well. So it's that flexibility of the lower pre-sales, lower hassle to get approvals, lower hassle to get it settled, and get back to doing what you're good at, which is finding sites and getting projects underway.
Yeah, absolutely. I mean, we get So, I mean, anyone that's sort of starting out with residential lending, exactly what you're saying, there's just so many boxes you've got to tick there when you're starting to look at development in a more serious sense, or you've got more projects. Obviously, you want to be looking at the options that you've got with commercial lending there. And you touched on this idea, the lifestyle developer and the performance sort of business, and that's mentioned in the book. If you can dive in a little bit more about that, sort of what's a performance business in terms of property development?
Yeah, so I guess probably the standout turning point would be the point at which you derive your whole income from the property activities. So if you've still got a day job and you're relying on that to pay your bills and put food on your table, that's probably still in the cottage or lifestyle thing, and that's fine. There's nothing wrong with that. At the point at which your income is purely derived from the property activities, and then you start employing people, I guess you will employ consultants per project, but if you started hiring staff to help out, admin team, office manager, development manager, project manager, sales teams, that's really when you're kicking into that next level. And I guess that's when you've got projects overlapping, you've got monthly DM fees coming out of those projects to help pay those bills to month, and you've got a balance sheet and a project pipeline that really shows that you're on that next level. And that's generally where the bank, I mean, you probably know that because the bank will ask you for that. When they start asking for that, that's probably the point that they need to justify to their credit department that you're still a mum and dad developer or cottage developer or lifestyle developer. And that's probably the point that you might not be. So in putting that together, that's probably the time that you'll find out that you're actually not anymore, and that you're starting to become a full-time, performance developer and creating, generating all your revenue out of that, those projects.
And so now that someone moves into that business phase, then we've got to talk about sort of what's the business model. Like, people go into development, they're like, I'm just building projects.
Yep.
But no, in fact, we've got to really think about this as, this is called the business of property, the business of property development. So what are the options in terms of business models? Is there one business model, or are there plenty of different business models?
Yeah, I'd say there's at least half a dozen different typical ones that we see. And to kind of rattle off a few, I guess there's the build and keep. So if you've built 6 in a project and you kept 2, therefore you're not kind of, repatriating all that profit back to your balance sheet. You're creating a bit of long-term passive income. You're also probably being tax effective because you're not paying tax on the $1.5 million profit to only end up with 750. You're kind of keeping a bit left in property and assets and income, which is great to see. It's good to see that when someone presents their A&L to us to make a credit decision, and we can see that they've kept some previous product. Whether it's super duper turbocharged cash flow positive or not, it's probably more around the fact that they did that project and they liked the project so much that they kept stock in it. So they weren't just doing it to turn a trick and turn a dollar. They were doing it with some foresight and some long-term thinking. So that is very good to see. And then I guess the other side is, is it a high volume business? Are you doing 50 lots of a cow paddock that's currently a cow paddock and turning it into houses, and you're just turning them over and they're just widgets in your machine, and therefore you need to look at, well, how much profit do I make per widget, per lot, per product, per house and land package, and how much do I need to, derive an income to make this business worthwhile and fruitful. So if you're making $80,000 per housing lot and you want to make, $3 or $4 million a year, you've got to do a lot of product per year to hit that goal. And then you start adding on 2 or 3 staff at salary of 150 grand a year, and all of a sudden you've got to make another 40 lots a year to pay those bills. So it's all of those kind of metrics that you start hitting into that you need to have thought about before you just go and hire a bunch of people and buy a bunch of raw land and hope it's going to work out. So it's having that little bit of foresight into that as well. And then I guess another business model is using other people's money in a bigger scale. So that's not to say borrow from your rich uncle and go and build some things. It's, are you going to partner up with a proper capital partner and go and build a number of projects that you otherwise wouldn't have been able to build? And so that looks like, for us as a capital partner, is partnering with a developer who's got the skills, the delivery expertise, the ability to find the opportunities. And what we would call that is they've got more opportunities than they do capital. not to say that they haven't no money. It's to say that they've got enough money to do 1, 2, 3 things a year, projects, and that we then come in as a capital partner and help them do 8, 10 projects a year at a time.
Yes.
So that we're turbocharging their pipeline, and they're then getting, and so that's the full performance model. And you'd be surprised how many big name developers that you probably think have big, massive balance sheets actually probably just have a good capital partner. So that's probably the I guess the upper end of taking it to the next level, and the max level is the full performance developer. I'd say that probably covers enough to cover the spectrum of business models that I think is worth talking to.
And just on in terms of what you guys do when you're joint venturing and looking at your partners, development partners, how much sort of skin in the game do you sort of expect? Like, how much, do you expect them to put some capital in as well? If so, like, what is it, a percentage? How do you determine skin in the game, or do you sort of go, no, not really, we don't need any?
Yeah, and so it's probably back to that thing before I said it's not about having no money and lots of opportunities. It's probably about having some and doing it and going on your own path as you currently are, but then partnering with somebody so that you can turbocharge that. So that's why I say they've got more opportunities than they do capital. So they've got enough capital to do 2 at a time, or 3 or 4 at a time, with their own balance sheet and their own resources. And it might be bank funding or a non-bank lender to fund all of those projects and fund the current pipeline. But then they've got more opportunities over and above that they can adequately fund. And so therefore they come to a capital partner to say, well, I could be doing these ones as well, but I don't have the capital to do it.
Because they're all tied up in other projects.
And so that might be us partnering with them in a sense that we repatriate some of the capital out of their current projects. So we've done that quite a lot in the last couple of years. And so that's a project that's mid-construction. They might have $2 million of their cash tied up in that project, say 4 to 5 million of bank debt in that project. They've now commenced construction. They've gotten through the risky parts of construction, i.e. now it's more finishing trades and the rain delays aren't really going to knock them around too much anymore, and it's just titling and marketing and selling. And so that for us is a lot more de-risked than it is when they've just lodged the planning application. So for us to get involved in that project is a much better, I guess, a lower cost of capital for the developer, as in a cost to them. But it's also easier for us to price because we can very quickly measure the risk left in our exposure on that project. Yes. And so us repatriating capital out of that project that's mid-construction is much better than us getting into a project where they've only just paid a deposit and submitted the planning permit to council. So for us, it might be a case of that. And that's probably, I guess, as a capital partner, is probably a little bit more single serving, i.e. that we're just coming in on this project here and there to help them with the overlaps of their project pipeline. And so that can be quite single serving, that it's just, okay, we'll just do a 2 mil top up here on this one. And then, 4 months later, 6 months later, we might do another 2 mil top up on another one. And so that's them repatriating their capital within their project pipeline. Whereas other ones might be one that they go, well, I am doing 1 or 2 at the moment, projects that are mid-construction, but I really want to do 7 or 8. And you'll see that more with either they've hit a sweet spot in a particular market niche. It might be a particular suburb where they've tied up quite a few sites at once that have all got a similar price point and product and a good delivery kind of forward pipeline of that product. Or where we've done more is in bigger townhouse projects. So I'm talking 100, 150 townhouses in a single project with multi-stage, and that we get involved and invest at the start and then stay in through the whole project. Or it might be where they're delivering a pipeline of opportunities like service stations, childcare, medical, small retail, some of those ones like those small kind of retail bulky goods type projects where you've got a good relationship with the tenant and you can roll out a bunch of them in quick succession. And it's more opportunistic. So you might have, like a childcare or a fuel operator that says, hey, I want 100 more sites in the next 2 years. And you go, great, we've got to jump on this mandate from them and we've got to deliver as many as we can in quick fire succession. And so that's, and we've done that with developers before where we've come in and essentially 100% funded the whole project for a profit share. And they've then been on the tools delivering the project, and we've been dealing with all of the finances on the other side. So that frees up their time so that they can do what they're best at, which is deliver the
Yes.
project, and then we can take care of the whole capital stack and deliver the whole project jointly together.
Yeah. I'll just ask one more little question around that before we sort of move on. When you're doing joint ventures, and you've got sort of a profit share, how do you factor into sort of development management fees and the profit share as well? And I know it's not one size fits all, but
yeah, so we
generally.
generally look at the size. I mean, some people like to say, oh, it's definitely 2% of construction, or it's definitely 3% of TDC, and everyone's got their own formulas. It's an open-ended question. My general approach of how I look at it is, how big is their business? Assuming the developer is the one doing the development management and delivery, how big is their business? Are they a one-man band? Do they have 5 staff? What do they need to turn the lights on each month? How many projects are we going to be doing with them? How many projects do they have on at a particular point in time? If they're asking for 40 grand a month and it's just them in their spare bedroom of their apartment, it's pretty unrealistic, right? So it's probably just more a case of what's going to see them not starving and putting food on the table, but also what's not them ripping out profits to pay themselves, and live a lavish lifestyle when the project hasn't even finished yet. So it's probably, I didn't answer it, but I'm kind of, I guess, saying that it does depend on the project and how it looks. We've definitely had a lot of conversation around this over the years of people saying, but I need 30 grand a month. And you're like, mate, if you need 30 grand a month, you shouldn't be doing this.
Yeah, exactly. It's enough, and it's enough to keep the lights on. But if you're going to have a profit share at the end, you've got to wait it out like the rest of the investors.
Yeah, absolutely.
Yeah. We've got a question here from Subo. Do you work with small developers to help them in becoming a full performance partner?
Probably not so much. So it's probably more the developers who have turned into a full-blown developer, as opposed to, I guess, if you're doing 1 or 2 projects at a time and you've got an income source already, it's probably still that you're actually better suited with a bank, and that might be borrowing against income in your house. It might be relying on your income to service the debt instead of pre-sales. All of those things. I mean, a bank's going to lend you 80% of site acquisition. We're only lending 65, sometimes 75. They're going to lend it to you at 3%. Our funds are generally 7.25%. So sometimes you're better off actually suited and staying with the bank as long as you can, because that's possibly a better outcome for you. There'll become, as I said earlier, there'll become a time where you realise it's actually time to deal with a commercial lender.
Yeah.
And that's at the time at which you're, you'll know it. Sorry, it looks like our cleaners have just come into the boardroom and he's dragging his mop and bucket up the.
That's all right. At least we know you've got a clean office there, Dan. That's a good thing.
Exactly.
This I love the name of this, sustainable capital. What does that mean? Yeah,
so I guess that's understanding the metrics and the points at which you can bring external capital into your projects. Like I was saying before about repatriating capital or having a capital partner to be able to make that capital sustainable. You'd be surprised how many of, as I say, the bigger name developers or bigger projects that you see that actually have a capital partner in there. Just because you don't see a capital partner like us or one of the other guys on the banner doesn't mean that they're not there in some fashion, or that they haven't raised money from investors, to get that project up and running. So I guess having a bit more knowledge around the capital stack and how it works and how it can work in your favour is what I refer to about sustainable capital, is at what point you can actually have the capital working for you rather than you waiting for the last product in every, hey mate, how are you? The last product in every project to sell and settle to get your money back to fuel your next project. So it's a little bit of knowledge, I think, that'll help people get ahead of the game in terms of using capital to their advantage.
Okay, so it's again the knowledge around and educating yourself as in what is the capital stack, and understanding as well. I guess it's whether it's first mortgage, second mortgage, equity, what the risks are surrounding each of those sort of in that stack.
Exactly right.
Excellent. So we've got another question here. When you hit serviceability constraints, to the usual suspects, and have a strong positive cash flow property portfolio ready, commercial and resi, is that a good prospect for you to look at?
I mean, that's fantastic if you're at that point where your portfolio of existing property is cash flow positive and you're able to demonstrate that you can possibly borrow more monies. Probably one point that I'd say there, and we're doing 2 of these at the moment, is kind of around they're built to rent, but not with like a government assistance rental. It's just both of them coincidentally are 10 products per one, and the bank, their house bank said yes, we'd love to fund it when it's built, and we'll lend you 65% LVR when it's built and it's tenanted and the tenants are paying rent, and their current portfolio is surplus to their debt requirements. That they almost probably could have got there if it was 4 or 5 products without any pre-sales. So we're coming in just for that 10-month construction period, and then they're refinancing back to a bank. So their debt income and their portfolio looks fantastic, but the bank still can't do it for the construction phase because the bank classes the construction phase as a lot riskier than when it's completed, tenanted, and cash flow positive. So that's probably at a point where you might need a lender like us or one of the other lenders to just do that piece, and then you take it back to your bank to do the ongoing income producing piece.
So you're talking about having them, they've already completed construction. You're coming in between that sort of, I've completed construction.
It's probably more so building it from a site to be a completed product. So to talk about rough numbers of one of those 10 packs that we funded, I think it was about 4.5 mil that we did construction. The end value was 660 or something. And so on completion, the bank would lend them for the 4.5 mil. But if they wanted to build it with the bank as a lender, they would have only probably lent 3 or 3.5 mil.
Yes.
So they would have had to tie up a lot more capital to get that done with the bank versus, and the bank would have funded it at 4.5-5% cost, whereas we're funding it at 7.25% cost, and yet they're having to put in $1.5 million less of their own capital because we know on completion that bank will refinance them kind of at the 4.5 mil when it's income producing and doesn't have construction risk attached to the risk metrics for the bank. So that's what I say is it's not necessarily that you shift all your lending to someone like us, and you shouldn't be borrowing with us long term. You should be borrowing with us to fill a need, which is to build the construction, take the construction risk, and then put the long-term portfolio back with the bank because they're the lowest cost of funds and they're much better at doing that. We're better just for that short-term burst. And that's why I say, 2 or 3% more for 10 months shouldn't kill the project, and we'll take higher risk and fund the project with more risk attached to it. But when it's complete, take it back to the bank, recut it at, 3.5% per annum, and then it's beautifully cash flow positive for indefinitely.
Fantastic. And so someone in the audience is saying that's the exact product we have. It's a rooming house, high yield. Are you funding many of those?
We possibly are. We've kind of haven't gone into the full build to rent terminology and who's doing what, but we're doing quite a few, and we just see them as no pre-sale product.
Yes.
So I know there's a few in Sydney we've quoted on that are like very small room apartment type product. We just view it as a no pre-sales project, and on completion, if the developer wants to keep them all in one line, great, go for it.
So it's just a refinance.
If they want to sell it, go for it. For us, we're just lending for that 10-month build, and they either refinance us or sell it and pay us back.
Yeah, you've got a fan here. Love it. That's the issue. Construction of high yielding rooming and then swap to commercial lenders, which is the bank. Fantastic.
Exactly. Yep.
So as long as you can see that there's an exit, what the exit strategy is, whether it's the sale or refinance, and you've got that confidence that the refinance is going to be from a lender, and what their requirements are. Excellent. Let's talk about what are the big mistakes. Let's talk about maybe the top 3 mistakes that you see developers, particularly with finance, and the things to avoid.
Probably not a big one, but probably one I'd say is a bit of a bugbear for us as broker and lender is people trying to tell you their whole life story and the story of the vendor's sick uncle and they've got to rush and do this and do that. As I said at the start, it's what are you trying to build? How much do you need to borrow? And kind of let's just figure out either does it suit us or a lender that it does suit as a brokerage kind of role for us, and what are the time constraints and what are your main objectives? Are you trying to minimize the capital you're putting in? Are you trying to get the cheapest interest rate? Are you trying to what is your motivating factor that you want us to focus on in the solution we give you? And then very quickly, within a couple of minutes, we can kind of churn out what is the kind of general typical ways that we would fund that project. And then you can tell us about the sick uncle who needs his money next week. Kind of, we don't need to hear all that detail. So that's, as I said, a little bit of bugbear, but probably other things in terms of mistakes, I'd say is, people not explaining themselves well enough of what they have done. People are often, I guess, a little bit shy to say how many projects they've completed or the lack thereof. I don't see that as a negative. I say let's talk about what you have done, and it might be that you've done 10 projects as a project manager, and this is your first one as principal. That's fine. Let's have that discussion now. And then probably the other one I'd say is, not explaining things to then ask, well, what's your best rate? What's your best rate? What's your max gearing? Do you lend 90% of cost? Well, yeah, we do sometimes, but we need to understand the project first before we can kind of say things that you'll try and hold me to, in the next conversation. So I'd say it's just taking it nice and slow and measured and explaining what you're trying to do. And it can be as simple as, hey, we're trying to borrow 4.5 mil to build these 10 things and we don't want to pre-sell them. We're going to refinance the bank on completion. Here's the project location. Great. I can answer that within 30 seconds of exactly how much it'll cost and how much we can lend you. So probably just being a little bit more relaxed in the approach. And look, I can understand there's some sharks out there in the private lending space that are a little bit more kind of angry and trying to hold you to account. I'd say it's just having an open discussion and saying, this is what I want to achieve and how can you guys help me achieve it? Because ultimately that's what we're here to do, is help developers get their projects funded. That's how we make our livelihood, and that's how our business has been successful so far. So I'd say calm down, have a measured approach, and just tell us the ABCs of what you're trying to do, and then we can very quickly give you an answer of what we think is achievable.
Yeah. And what would you say someone that's looking for finance, and the first question is, what are your rates then? I've got it cheap. I've got it cheaper here. Can you beat that?
Yep. So, I guess definitely banks are always the cheapest cost of funding. They provide the cheapest cost of funding. They're always going to be the cheapest. We're never trying to steal loans away from the bank. But there's many cases where it doesn't suit the developer to wait for the bank to jump through those hoops, and that a private lending solution is actually a better outcome. Our interest rates start at 6.95. They have been for the last 18 months. We're not planning to go much cheaper unless something crazy happens. There's a lot of capital around at the moment. That's why we dropped them from 6.95. Most construction loans we do are from 7.25. It's more about how do you maximize your capital. Not that we want to charge 10% plus, but I'd say it's more a focus of how can you use our funding to your advantage, as opposed to spending 2 months trying to find someone who is at 5.5%, because there's probably not many that are that cheap, or if they are, it's because they do 10, 15 million only and above, because they're doing bigger projects with lower risk. So it's more about finding what's fit for purpose for the project that you've got, and then figuring out how to make that work to your advantage.
Yeah. So question here, are you national? So do you lend in all states?
We do, except we just today decided not to lend in Perth because we just got repaid on a couple that were there, and it just is, it's pretty tough. So we've got offices in Brisbane, Sydney, and Melbourne. We're happy to look at Adelaide. We do regional Queensland, but we've done a couple in Perth, and it's just everything takes a lot longer over there. So literally today we've decided to no longer lend in Western Australia. But on the brokerage side, we've got, I'd say, at least a dozen lenders that will lend in Western Australia. So still happy to have a chat and see if we can find a solution for you.
Excellent. Well, I know I don't want to sort of divulge too much of what's in the book. It's definitely worth a read. Anyone that's looking to get into development and looking to get finance, if you're already in that development space and really wanting to find out more of the nitty-gritty about construction finance, highly recommend getting a copy of this book, where I will send details. Where are the best places to get a copy of the book?
So it's all done through Amazon, because I'm not into publishing, so they take care of it all. They also take most of the revenue, so no, I'm not doing it for the money. They take pretty much all the fun out of it, but they also take a lot of the hassle. So if you buy it from Audible, they'll deliver it generally within 2 or 3 days, which is fantastic. It's spot printed and posted to you straight away. They deal with all the payments and everything like that. There's also Amazon Kindle, so you can download it to your device. And we're having a lot of trouble getting it up to Audible, but it's recorded in Audible format. And I listened to 2 hours of it today, and it sounds really nice. So hopefully that's up by the end of the week, but it might be next week by the time you can get it on your Audible on your iPhone, listen to it on your morning walks.
Cool, bananas. But if they want to get a copy of the hard copy, that's constructivefinance.com.au.
Correct. And that's got a bit of a blurb about the book and why you'd buy it and all that kind of jazz. And then there's a link to the Amazon site there.
There we go. So constructivefinance.com.au. Someone's getting it for Christmas already. There you go. Santa's delivering. And also if you want to get a copy of chapter 1, here we go. We've got to pop up the link in the notes as well. Any type of developments you won't do?
Steer clear of retirement for a long time because it's very capital intensive. It takes a long time for that deferred management fee to kick in and really start showing profits and dividends. So it's probably something that I haven't, I have done in the past, funded and arranged funding for. It's probably something I'm not going to run out and do anytime soon. But I'd say, generally speaking, we do a lot of different types. We're doing a lot of industrial at the moment. Again, I think the banks have really clamped down on local businesses paying $5,000 and $10,000 deposits, small deposits. So they're needing a non-bank solution. Doing plenty of land, plenty of townhouse stuff. Probably the one thing we're steering a little bit clear of is like the $5 million per floor apartment stuff. There's a lot of that up here in Queensland. We're probably just a little bit, either full or not overly confident on that market being a little bit crowded. So yeah, probably not jumping into that space. But generally speaking, if it's real estate development and it's 9, 12, 15 months in and out, us as a lender can get our money back. We're pretty happy to have a chat about it.
Fantastic. All right. And if you'd like to get a copy of chapter 1, constructivefinance.com.au/first-chapter-free. I've got to make sure I update that link there, but I'll pop it on the Facebook page as well. Fantastic, Dan. Thank you so much for sharing.
Thanks, Cheryl. Appreciate
it. I have enjoyed reading the book. I'm going to spend more time diving into it because there's some really poignant sort of important notes in there and educational pieces in there about getting yourself finance ready as well for your projects. So appreciate all the best for the book. Congratulations again for your 10-year anniversary and Merry Christmas.
Yes, same to you. Thanks very much for the invite.
This is the last episode for the Business of Property for the rest of the year. So it's a great way to round up. So thank you so much, everyone, from myself, my family, and from myself to all of you. Thank you for tuning in for the Business of Property throughout the year. It's been a crazy 2021. I'm looking forward to a fantastic 2022. And I'd love for you to be able to subscribe to us on YouTube. I am on Cheryl Leong on YouTube, where you'll find our past Business of Property videos. If there's anything in particular that you want to find out more about in the Business of Property, please put it in the comments below. If you want to be a guest on the Business of Property, pop in the comments below and tag me as well. It's been an absolute pleasure, and I can't wait to have a lot more sessions of the Business of Property next year. So take care. Goodbye, everyone. Have a Merry Christmas, and we'll see you next year. Bye-bye.